Welcome to the deep dive. Right, we've been digging into the latest results from Adani Total Gas Ltd ATGL, specifically their Q2 and H1 numbers, ending September 30th, 2025.
Yep, got the financials, the media release, the whole presentation deck here.
And our mission today, well, it's more than just reading out figures. We're trying to get under the skin of this story. You've got this company, ATGL, expanding its physical network, like crazy pipelines, CNG stations, you name it.
Yeah, the scale-up is undeniable.
But that operational push, it's hitting a wall, a pretty significant wall of rising energy costs. So we need to look at what's driving the volume, their strategy for sourcing gas, which is getting tricky, and how they're funding this big pivot into things like e-mobility.
It's a fascinating mix, definitely.
Okay, let's unpack this.
So the first half scorecard, H1 of FY26, it really sets the stage for that exact tension you just described. Operationally, they look strong, good growth, resilience. But the cost side, well, that's biting into the margins, even with strong demand.
Let's start with the good news then. Top line. Standalone H1 numbers year on year. Revenue from operations shot up 20%. Huge. INR 3,060 crore.
Yeah, see? That tells you the demand is there, people want the gas, the network's working.
But then you look a bit lower down. EBITDA.
Right. That's where you see the pinch. INR 603 crore for the half year, which is, believe it or not, slightly down. A 3% dip year on year.
Okay, so revenue up 20%, EBITDA down 3%, and Pat, the profit after tax.
That followed suit, down 9% year on year, landed at INR 324 crore. It's that paradox. Selling way more, but profitability is under pressure.
Selling more, but making less per unit, essentially. Let's nail down that volume growth again. How much more are they actually selling?
Overall sales volume for both Q2 and the first half was up 16% compared to last year. Solid double-digit growth.
And the split between CNG and PNG?
CNG was the real driver, up 19% for the half year. That's clearly linked to rolling out more stations. PNG, the piped gas to homes and businesses, also grew, but a bit slower, up 9% year on year for H1.
Right, and on those homes, there was a massive milestone number in the report, wasn't there?
Oh, absolutely. The big one. They officially crossed 1 million PNG household connections.
1 million homes connected. That's huge scale.
It really is. The exact number was 1.02 million domestic connections by September end. It really cements them as a major national infrastructure player now. Shows they're delivering on those geographical area commitments.
Okay, so that volume, that revenue, those million homes, it all depends on physically building stuff. Pipes in the ground, stations on the corners. How did that standalone expansion look in Q2?
Relentless, basically. They added another 12 CNG stations just in the second quarter. That brings their standalone count to 662 stations.
And you pointed out something interesting about the type of stations.
Yeah, the quota mix. Of those 662, 129 are company-owned, dealer-operated, or dealer-owned, dealer-operated.
Which is smart scaling, right? Lets them expand faster without taking on all the upfront costs themselves.
Exactly. Shares the load, speeds up penetration into new areas. And on the PNG side, connecting those homes, they added over 26,000 new household connections in Q2 alone and laid enough steel pipeline to bring the cumulative total to around 14,524 inch kilometers. Serious groundwork.
Now zoom out a bit. Include their big JV with Indian Oil, the IOAGPL venture. What does the combined national footprint look like now?
It's vast. Together, they cover 53 geographical areas, 125 districts. That's, over 14% of India's population potentially covered?
Asset count.
Combined, nearly 1,100 CNG stations, 1095 to be precise, and PNG connections nudging up to 1.21 million households, plus nearly 11,000 industrial and commercial connections.
And the JV itself is performing well operationally.
Yep, mirroring the standalone growth, pretty much. IOAGPL also saw volume growth of 19% year on year. Strong performance there, even if it comes through as just a share of profit line item for ATGL.
Okay, here's where it gets really interesting. We've got the infrastructure story, the volume story, massive success. But the profitability dip, that cost crisis, what actually happened? Why did PAT drop 9%?
It boils down to gas sourcing. Specifically, the cheap gas dried up. The combined allocation of APM gas, that's the administered price mechanism stuff, and the newer, but still somewhat regulated, NWG or New Well gas, that mix fell sharply.
Sharply.
It was providing 70% of their needs in the first half of last year. This year, H1 FY26, down to just 59%. And in Q2 specifically, it was even lower, only 48% APM plus NWG.
Okay, wait, let's just clarify for everyone listening. APM gas.
Yeah.
That's the super cheap government-regulated price gas, right?
Right.
Losing that allocation hurts badly.
Hurts really badly. Think of it as their baseline low-cost supply. It's largely insulated from global price swings. When that allocation gets cut, they have to buy replacement gas on the open or semi-regulated market.
Which is much more expensive.
Much more. In this case, they filled the gap with higher-priced New Well gas, which isn't as cheap as APM, and also HPHT gas, high-pressure, high-temperature gas, which tends to be costlier still.
So their own success in expanding demand forced them to buy more expensive ingredients, basically.
Precisely. And that dynamic pushed their overall cost of natural gas up by 30% year over year in H1. 30%.
Ouch.
And adding insult to injury, the US dollar strengthened against the rupee by about 4% during that period. Since some gas contracts are dollar-linked or globally indexed, that just adds another layer of cost.
Right, so less cheap domestic gas, more expensive domestic gas, and the stronger dollar hitting imports or linked contracts. That's a perfect storm on the cost side.
Absolutely. A triple whammy, as you said earlier.
So how are they fighting back? What's the mitigation strategy?
Portfolio diversification is key. They're deliberately managing their gas sources. They're not just relying on domestic APM and WG anymore. They've built up international exposure.
How so?
They've got Brent-linked contracts, that's crude oil-linked, making up about 14% of their portfolio, and Henry Hub-linked contracts, that's the U.S. gas benchmark, making up around 17%. And they're buying these at different lengths, different tenures, to try and smooth out the volatility.
And they mentioned a calibrated pricing approach. What does that actually mean in practice?
Well, let's connect the dots. Costs jumped 30%. Revenue, driven by volume, up only 20%. Margins squeezed. It strongly suggests they aren't immediately passing on that entire 30% cost hike to consumers.
Ah, so they're absorbing some of the pain to protect market share, keep the growth engine running.
That's what calibrated pricing seems to imply here, yes. They're likely making a strategic trade-off. Accept lower margins in the short term to keep customers happy, maintain volume momentum, and avoid demand destruction. They keep saying consumer interest is central.
But that's risky long-term if costs stay high.
It is. Sustain high input costs without eventual price pass-through will keep depressing profitability. They need costs to moderate or pricing to adjust eventually.
Okay, but there was some good news on the cost front, a regulatory win, the tax thing.
Yes, a neat little win. For gas they supply outside their home base of Gujarat, there's been a change in how tax is applied in the supply chain. Instead of a 15% VAT, value-added tax, they now face a 2% central sales tax, CST.
Net difference, 13%. That's significant.
It is significant for those specific routes. It lowers their effective logistics or landed cost for that gas. And they've said they plan to pass this benefit on to consumers soon, which helps affordability, might even nudge volumes up a bit more.
Right. Okay, that helps the core gas business. But let's pivot to the future. Where's the new investment going? The energy transition stuff.
Yeah, they're definitely not just a gas pipe company anymore. They're pushing hard into e-mobility and biomass.
E-mobility first, through the Adani Total Energies E-Mobility Limited, ATEL. The charging network seems to be exploding.
It really is. They've hit 4,209 installed EV charging points now. That's across 26 states, 226 cities. About 42 megawatts of installed capacity.
That's a lot of chargers. What's the strategy behind the rollout?
What's interesting is their focus. They're deliberately targeting B2B clients, businesses, fleets, workplaces. The idea is to get higher, more predictable utilization rates compared to just scattering public chargers everywhere.
Makes sense. Ensure the assets are working.
Yeah. And they have an ambitious internal target, aiming to install 10 to 15 new charge points every single day. So the pace isn't slowing down.
Okay, and the other diversification, biomass.
That's under Adani Total Energies Biomass Ltd, ATBL. In the first half, they sold 804 tons of CBG compressed biogas.
Which is basically renewable natural gas made from waste.
Exactly, but the really interesting part is the circularity. They've also launched their own brand of fertilizer, Harit Amjit, which is the fermented organic manure left over from the biogas production process.
Ah, so using the byproduct.
Right, and they're already selling that fertilizer across UP, MP, and Gujarat. So it's waste to energy, and the waste from that process goes back to agriculture. It's a neat, sustainable loop.
Okay, shifting gears slightly, corporate health. You can't fund all this expansion pipes, stations, EV chargers, biogas plants without financial stability. Any external validation on that front?
Very strong validation, actually. Their long-term credit rating got upgraded, not just by one agency, but by three. ICO, CRISIL, and CARE all moved them up to AA plus with a stable outlook.
AEA plus stable. That's pretty solid. What reasons did the agencies give?
The usual suspects for a strong performer: expanding scale, healthy volume growth, robust gas sourcing arrangements. Interesting, they noted that despite the cost pressures and, crucially, a strong financial profile.
Okay. But given the sheer amount of capital expenditure needed for all this, pipes aren't cheap, EV networks cost a bomb. How much of that AA plus rating relies on, the strong parentage factor the agencies also mentioned? Is the balance sheet truly robust on its own?
That's always a fair question with conglomerates, right? But the numbers suggest good discipline. Their net debt to EBITDA ratio is currently just 1.16 times.
1.16x. That's actually quite low for an infrastructure company in heavy investment mode.
It's very healthy. It suggests they have significant borrowing capacity left, headroom to keep funding the capex for both the core gas business and these newer energy verticals without overstretching themselves, even while managing the tricky gas cost situation.
Got it. That context helps. Okay, final area. The regulatory environment. There was mention of a big discussion around zonal tariffs for gas transport.
Yeah, this is a potentially major shift overseen by the regulator PNGRB. They've essentially proposed putting all CGD players for their CNG and home PNG customers under Zone 1 tariffs nationwide.
Zone 1, that usually means the shortest, cheapest transport distance, right? Like 0 to 300 kilometers.
Traditionally, yes. So the idea seems to be about simplifying and standardizing the tariff structure across the country. They want to merge the previous three zones into just two.
What's the impact for ATGL or anyone else?
Well, potentially simpler billing, maybe some rationalization, but it's complicated. Merging zones means the definition and price for the new Zone 1 and Zone 2 needs very careful calibration. You can't just apply the old Zone 1 price everywhere.
Right, because the actual transport distances haven't changed.
Exactly. So the full implementation is still pending. They need industry consultation to get consensus on what those new zonal tariffs should actually be for different types of customers. Getting it wrong could mess up the economics for companies operating further from gas sources. It's a tricky balancing act for the regulator.
Okay, so wrapping this up for the listener, we've seen this story of really impressive physical growth hitting that 1 million homes milestone is a huge symbol of that.
Definitely.
But that very success has collided with the harsh reality of gas procurement. The cheap supply dropped, costs rocketed 30%, and near-term profits took a hit.
Yeah, the core takeaway for me is resilience and maybe strategic patience. ATGL is managing to execute on two fronts: keep building the core infrastructure at pace and invest heavily in the future energy stuff like EVs and biomass. And they're doing this while navigating, a pretty tough high-cost gas market, using that diversified sourcing and, as we discussed, that calibrated pricing, essentially carefully balancing growth today versus profits today.
That balance feels like the key theme. We saw their net debt to EBITDA is healthy, 1.16x, giving them financial muscle. But here's the final thought to leave you with. We know the subsidized gas supply is likely to keep shrinking, and they have to keep investing heavily in EVs and biomass. So, how critical will nailing that gas sourcing optimization, getting the best possible price for every molecule, and crucially, having the nerve to implement effective pricing strategies eventually be to actually maintain that strong financial health and keep funding the future?
That's the multi-billion-dollar question right there. Efficiency on one side, pricing power on the other.
Exactly. That wraps up this deep dive. Thanks for tuning in. We'll catch you next time with more insights.